welcome to our Advanced Trading Concepts series. Today, we're diving into the realm of advanced techniques in technical analysis. Technical analysis is a crucial tool for many traders, and mastering its advanced techniques can offer deeper insights into market behavior and enhance trading performance. Advanced technical analysis involves more than just basic chart patterns and indicators. It encompasses a range of sophisticated analytical methods to decipher market trends, predict potential turnarounds, and identify high-probability trading opportunities. Advanced chart patterns include the Elliott wave theory, which proposes that market trends follow a predictable five-wave cycle. Gartley patterns, a complex harmonic pattern indicating potential reversals, and the Ichimoku cloud, a comprehensive indicator providing information on support, resistance, trend direction, and momentum. For example, a trader might use Elliott wave theory to anticipate the end of a market trend and prepare for a potential reversal. Advanced technical indicators include tools like Fibonacci retracement, used to identify potential support and resistance levels, Bollinger bandwidth, which measures the volatility of the market, and RSI divergence, where the indicator diverges from price action, often signaling a potential price reversal. Traders might use Fibonacci retracement levels to pinpoint strategic entry and exit points, capitalizing on natural market retracements. The integration of quantitative analysis with technical trading involves using mathematical models to backtest trading strategies based on technical indicators and patterns. This approach allows traders to validate the effectiveness of their strategies using historical data. For instance, a trader might develop a quantitative model to test a trading strategy based on Bollinger Bands across different market conditions. Behavioral finance also plays a significant role in advanced technical analysis. Understanding how psychological factors affect trader behavior can provide context to technical patterns and enhance the interpretation of market sentiment. For example, a sudden shift in market sentiment might be anticipated by recognizing specific technical patterns, coupled with an understanding of trader psychology during market extremes. Despite its utility, advanced technical analysis has limitations. It's not infallible and can be prone to producing false signals. Market anomalies and external factors not reflected in price movements can affect its reliability. In conclusion, advanced technical analysis offers powerful tools for traders seeking to deepen their market insights. While it requires rigorous practice and continuous learning, mastering these techniques can significantly enhance trading decision-making and strategy development. Exciting topics await in our Advanced Trading Concepts series. Join us as we deepen your insights into the financial markets. Thank you for watching. Don't forget to subscribe to our channel and hit the bell icon so you never miss an update.